Hi everyone, Nick Shaheen here. MarketFi, create income with option spreads. Recapping week ending May 23rd for Benzinga and looking into next week. This week was incredibly active and was not disappointing as far as action is concerned. So, looking as to recapping what happened, the week ended on a bullish note for sure, even though there were some things that were a little confusing. But the buyers stepped up in the last couple of days, and some of it was a little surprising. Other was not so much. But just to recap how things ended as far as week is concerned, to put it into visual terms, let's look at the ES, for example, which represents the S&P, and we did end on a high today. Although it still played within, if you remember last week, I mentioned the fact that among all the volatility, we still had relative predictability, very strong predictability as far as ranges. So it's perfect when you know the range. It's really good for credit spreads because then you can set the risk outside of the credit spread, the range, and have the credits you collect dwindle down, and then you buy them back. And that's what we did all week. Today the S&P looked really good as far as I expected it to break down several times a day, but it didn't. It kept on going, and the momentum kept on building on itself. And I'm not sure if it's encouraging for long-term purposes or not, because I did see a few things that I did not like. For example, this is the first time where I've seen in a while, at least, I don't have it on paper, but I can look it up, where the markets ran up green in the face of a strong TLT, which has been market killer, and a weak TNX, which represents the yield on the 10-year, which also has been a market killer inversely. So if the TNX drops, the market drop. So yet the opposite was true for the TLT. If the TLT ran, the markets dropped. So what happened? Is this a turning point or not? This is a real important question, and I need a couple more days, I guess, to get the real answer by seeing the action as opposed to theory. I have theories, but that means nothing. Today, the market makeup was as expected. What do I mean by that? In other words, the broader indices were strong, but the small caps and the more violent stocks were stronger, and the VIX was red. So that is what I expect on a bullish day, setting aside the fact what I just mentioned about the TLT and the TNX. And I'm tired of mentioning those two, and I hope I don't have to continue mentioning them for a long time. I did expect, the surprising part was I did expect some weakness into the close because of the upcoming Ukraine elections. So apparently the markets decided that nothing is going to scare them out of the Ukraine, not even a breakout of war in there. I'm not sure what's going to happen, but we haven't heard enough, so therefore we're not sure. But we're turning the blind eye, we as in the collective market and traders. So the traders bought it. They did break the 1900. I think the settlement price was like 50 cents within the higher than the 1900 as far as SPX is concerned, and market makers won again because that was the line in the sand for them, and they defended it again. The question is, can they run it up next week? Remains to be seen. So bullish end of week. Credit call spread still paid because of what I just said. What does that mean? It means that, for example, if I looked at the open interest, and I've been telling members all week long that I'm comfortable selling risk outside of the range, correct? And if the range stopped at 1900, I sold risk higher than 1900 to give myself a buffer, and and that risk dwindled down to nothing. I did that early in the week. Last night I sold some risk and I closed it at the open for about 40% of profit, and I sold it at the 1900, which wasn't a big buffer for me, but I felt a little crazy. But I closed it. I had the discipline to close it early in the morning, and I went online and I said I've closed my risk for today just in case we do run up in some stupid, and indeed we ran up. So book profits, I'm going to continue to do that. That's part of the plans. Credit call spread still pay. and you can add credit put spread to make an iron condor, sell the iron condor, collect the premiums, and rinse and repeat. So recap: bullish, yes, but the range is still in play. Everybody now is saying it's off to the moon. Maybe it is, maybe it isn't. But they're conflicting. I can argue both sides of the fence, and I'm gonna stick with the status quo until it breaks. So if I set up some credit spreads, I'm going to make sure, just in case everybody's right, I'm going to make sure I leave room in time and space. What does that mean? It means if I sell a credit call spread, so I sell, I'm basically bearish. I'm going to do it, give myself a good sized buffer from current price. So if the SPX is at 1900, I'm not going to do it in 1910 or 1915. I'm going to step up to the mid 1900s if I can still find premium. And if I can't find premium, I'm going to step out in time. I'm not going to do it next week only. I'm going to do it 2 weeks out, 3 weeks out, maybe even to June, maybe even further than that. If I'm going on vacation, I make sure not to schedule anything within the vacation time frame. I'll go out even to December and go higher, much higher. So you can choose the level of risk, where to place it, where to place the risk, and when to choose your time frame. And then let it suit your lifestyle. If you're not one to watch your monitors, you don't pick weekly trades. I had a member that had a too tight of a trade going down to the wire when they weren't able to watch the screen all day. So that was, it would be better off if you give yourself some time or book it early. Luckily, the damage wasn't that great just because the 1900 level held. And as far as the upside is concerned. So in general terms, I'm going to continue doing what I've been doing, which is selling iron condors and trying to range bound this action. It feels like, the low 1800s are fairly safe and the mid 1900s are fairly safe. So I'm going to find premium to sell at those ranges. Now there are a few, I've been saying buying momentum has not paid so far this year, and I have shades of two that might be, and so I'm going to mention the two champs this week. I don't think they get enough coverage, which are, we had Google and Netflix. They had incredible weeks. I mean, look at this, and it's consistent chug up. This is like sentiment turn. I personally felt, and I've said it publicly many times, that all of this in Google, all of this action in Google right here, was undeserved. As a matter of fact, I'm going to build a box around it. This craziness right here in Google was just, I don't know what that was. Somebody going crazy. This kind of candle, this big of a candle right here, 4% in one day in Google, I think that was the day. What? Unless they came out and did something wrong or said something wrong, just for the fact they traded it down with the momos. So this week was correcting all the craziness. So now we're back to even keel. From here on out, the fight goes. I like Google. I'm long it from the lows via leaps. In other words, I sold puts in Google that are January, and they were at $40, $45 or whatever it was, and then now I'm just sitting pretty on those. I did hedge them this week, and I shorted a couple other momentum stocks via leaps. So I sold calls on those other stocks with plenty of room. Believe me, plenty of room, and very small. It's like 7 to 1 or 8 to 1, so 8 longs to 1 short. So just a token short. And so Google is a champion, and the other one is Netflix. Something happened in Netflix where now suddenly everybody's back on board saying, hey, you know what, I'm on board with Netflix growing their base abroad. For a while it looked ugly, it looked head and shouldery, it looked like it was heading to 275-ish. That's why I drew that red line right here. But now incredible week and on decent volume as well. So the volume this week was probably a little bit stronger than Google's. So this is convicted buying on conviction. But now we go to get to this level right here. So let's draw a line on this one here. So now I ask myself, all right, so do I dare go along it here? Technically, it still can go, I mean, moves like this don't just turn on a dime. So if I want to participate, it won't be a full position. It will be just something to participate via debit call spreads, for example. Call flies, if you like those. I like straight out call spreads. Make it something cheap or right at the line so you can get a chance to bail right out. I wouldn't do it in just of next week, even though the move will happen next week. If anything, I will give myself some time to be right. Just in case it moves against me, I'll have something to salvage. What does that mean? If I go out in time and Netflix goes against the trade I put, then I won't lose all of the premium. Yes, it moves, I benefit slower if Netflix goes, but at least I have something to salvage. I personally choose to give myself some time, unless it's a lotto. Lotto is different. The lotto is where I choose the cheapest, so far away from the line, and I don't care about time because I'm specifically looking at one event. So those two champions, you could ride the momentum. I just mentioned two ways of doing it. One via selling puts if you have the margin and the know-how. Dangerous to do that. You can do it a put spread, for example. But I don't want to be close in time, just in case they go crazy again. They start selling everything under the sun. So give yourself some time so that the moves don't go against you quickly. All right, so time is of the essence, and consider your lifestyle while doing that. So in general, I'm going to continue doing the same, playing the ranges. The difference is two differences. I'm going to try to capitalize on some momentum, and I'm choosing Netflix and Google. I chose Google already, and I may choose Netflix next week. And you know what? Why don't we throw in Apple? Just because now suddenly seems like it silenced a whole bunch of critics. Sorry about all the lines, but they all mean something. I say it all the time. So I zoom out every time I'm looking at Apple to remind myself of the ugly days. So these were the ugly days, and now we're in the ugly days territory. Which are those? It's this one right here, kind of like the NASDAQ .com bubble. Now we're in the ugly days right there, just the bottom of it. So caution. But if I want to run it up for next week, I may be able to do it. Again, just like Netflix. I'm not too convicted with it. Maybe 10 bucks on the upside, 15 bucks, but I don't think it's going to go a lot. The closer it gets to 700, people are going to remember, oh, what happened last time it got to 700? I love Apple. I think it's a premier company. I've said it before. I went on record. I've said it on the show, Options House with Benzinga. So I'm a proponent of the company, but I'm not going to go all in on Apple right now. And if I was red and now I'm close to even, I may trim a little bit, back off, or defend it. And if you don't know how to defend it, you can do it for free. If you own the stock, let me know. We have a few ways we can work with that. I'll show you. I'll teach you how to do it. So trying to carry on the momentum. Now, if I wanted to be bearish, on the bearish side, I noticed that, I didn't notice, I've noted several times that the VIX is too low. What does that mean? It's at extreme lows. So let's pop into the VIX and show you in pictures. All right, let me draw. Last time, gosh, maybe I should go out 2 years. There we go. So 1 year is not good enough. So I'm going to go out 2 years, okay? And this is the close for today, 11:40 something. So check it out. So every time it goes down to here, and if you do the weekly, I don't want to change it right now. Let's see if we can change it to weekly. That illustrates the point better. I misdrew the line anyway. Look at this. This is 1 week where it hit this level before in extreme low. That's 2 years, mind you. Keep that in mind. So it's not like just 1 year. Look what happened the next week. A doji, but a lot higher than where it was, right? So my point is, not much downside. There's blank down here. So are we about to change this week? If I were a betting man to bet my life on it, I wouldn't. I would bet my life that it's going to go the other way. If I was forced to either bet my life or not, I would bet my life on the upside from here as far as VIX. So what happens when the VIX rises? Usually there's a reason for it to rise. It doesn't rise on good days. It rises on bad days. So that's a cautionary tale. That's why I'm not all in with this. We're going to the moon. So if we're going to the moon, where's the VIX going? Okay, so it's just why I would be worried a little bit about it and not jump in with both feet. I'm not shorting at will, but I'm not jumping in with both feet. So on the bear side, an extremely low VIX would make me want to continue doing some call spreads, but I'll move them up a little bit. Credit call spreads. So I'm shorting, but because it's an iron condor, right? I'm shorting and going long. So I'll move it up a little bit. I do have a lotto ticket that I plan on taking. Twitter. Yes, call me crazy. Twitter. Why? Because nobody else would. Look at this, the blue line. All the way down, all the way down. It's hideous. But I'm on Twitter every day. Tons of, tons of exposure. Every show has got Twitter this, and tweet that. Everybody's on Twitter. It's a convenient way of people having a social life. And the use of it is growing, and sooner or later, they're going to figure it out how to turn it into money. If not them, somebody else will buy it and put it to use into their own system. Hint, hint. Okay, I know they said Google wanted to buy overseas companies, but why not here? It's just too good of an asset for it to go to waste. It's gonna get picked up, or it's gonna work. Same for a while. If you look at Facebook, everybody thought, oh my gosh, I've said before, it takes a special kind of idiot to mess up 1 billion users. That's in case of Facebook. Well, it's going to take an extremely bad situation to mess up a heavily used thing like Twitter. And that's my own opinion. So I'm going to take a flyer. What does the lotto mean? It means it's a cheap few $100, throw them and see what happens. I'm not going to say it's going to happen this week. I'm going to give myself time. Same as I did with Yelp. I went Yelp. I noted it. I forget exactly when, but I said I'm taking a lotto ticket in Yelp because of this square, and I said, it's not going to go down here, so I'm going to take a lotto ticket. I don't know when it's going to happen. See, this slide is like Twitter, so I said I'm consistent in this. So I bought calls, but out to June, so I want at least a few weeks for me to be proven right. And sure enough, it's running nicely. I don't have a ton of money in it, but I'm participating. So again, what do I want to do? I want to silence this phone. Sorry about that. Technology. I want to still sell credit call spreads, but nowhere near this line. I mean, it's been working fine, but I see an upward trend, and it's higher lows knocking on upper levels. Every once in a while, there are two streams of thoughts here. One is that the bears will get tired of selling that level, and then will succumb to the push from the bulls, and then boom, it will run up a little bit. Or we can argue for higher highs as well, so kind of like the trend is going to break to the downside. There's a chance they're going to poke through. How high they're going to go, I'm not sure. I'm going to try to find some premium to sell up here. I'm not going to be greedy. This week I even tested the 1900. Luckily I got out in time, and I posted exactly when I got out, and a whole bunch of friends followed. And my logic was we had some economic new homes coming out, and I didn't want to be in front of it. What if they came out great and the market will run? And sure enough, it was exactly the right time to get out. It wasn't luck, I just wasn't greedy. I took 40% of maximum gain, and that's what you need to do. If you have profits anywhere, book them, and then you can repeat the same play later. So I'm going to try to sell some risk up here, and I'm going to butt up some other risk down here, which is credit put spreads. There are some pretty defined levels, like the low 1800s have been defended fiercely, like this one right here. So I'm very comfortable here. I can play in time. So if I sell spreads here, I can go out further to play the low 1800s and further in time in order to collect the kind of same premium. So it'll be a lopsided iron condor of sorts. But at least it lowers the entry point of one leg or the other. So if you're brave, you can go closer to the 1850, which also has been vigorously defended more often, but not in the ferociousness of this one. So that's the plan. You can do this in any other index. I'm saying indices. Why? Because that takes away the stock particular moves. This is 1 year again. Same thing here. You can do it with the IWM if you want. whatever you have a good beat on. So people are saying we're off to the moon, we're off to the moon, right? So this is a run that failed. This is a mini run that failed. This is a run that failed. This is a run. Will it fail or not? If it doesn't fail, then it has a good size of upside. Now, if you're short a few things, if I was short a few things, I would want to defend next week. Why? Something we haven't mentioned yet is Draghi. Okay, Draghi is an incredible speaker. He's got a black belt in Aikido, but recently his speaking only is not paying off anymore. So he is expected next couple of weeks um, to weaken the euro. So because the recovery is not so great over there, kind of like what we were, kind of a recovery, put it in quotes, whatever, for whatever it's worth. So he's going to weaken the euro to spruce up exports probably. And how do you do that? He's going to probably print money. So he's going to promote some sort of a stimulus, and traders might interpret that as bullish markets. Now, it might have some offsetting effects on currency, therefore bonds, whatever. I'm not smart enough to preview all of that or foresee all of that. But I think the initial reaction would be that traders will say, oh, stimulus, regardless of where it's coming, Europe is recovering, companies are going to make money, they're going to buy the market, so I want to defend. So if I'm short via credit call spread, I'll make sure to add a credit put spread in order to bring in more premium to allow me time to react in case something moves against me, and or I should say, will buy some debit call spreads, smaller, closer to the line, maybe one for every 10 contracts, or depends on the time frame I'm short. So I will definitely defend or think about defending, or at least have a plan on how I'm going to defend such a move. So again, the concern is for the bears is that Draghi may need to provide a QE of some sorts because he's expected. Now, the flip side of that, if he does not deliver, or if he disappoints, if he delivers and it's not big enough, look out below. Okay, because he's been promising, oh, we're going to do more, we've got more, we're going to do this, we're going to do that. Time to put up or shut up, as they say. If he doesn't deliver in the next couple of weeks, look out below. But until then, I think the markets might have the wind in their back as far as building, pricing in something from Draghi. They may have already started that this week. It may be part of what's driving markets up in the face of a rising TLT and a falling TNX. That's my theory. So until next time, I urge you to, if you don't do options already, look into options. If you don't know where to get started, email me. I can be reached at sellspreads@gmail.com. I answer every email. Or you can hit me on Twitter or message me through marketfi.com. Message system is incredible. I get the messages, I respond immediately, and I'll get you started on the right track. Until then, thanks for your time, and this time it's about 20 minutes or so. Almost hit my target. I'm trying to stay within 15 minutes. I'm failing every time. This is Nick Shaheen for MarketFi and Benzinga.